Welcome to The Explainer. What happens when a company becomes so tied to its legendary leader that you can't imagine one without the other? Well, today, we're digging into the future of Berkshire Hathaway without Warren Buffett, and we're using a really sharp analysis from Barron's that points to a surprising disconnect in the market.
Okay, so let's get right into it. We're talking about one of the most respected companies on the planet, Berkshire Hathaway. But there's a puzzle surrounding its stock price, and it's costing the company billions. And believe it or not, this whole puzzle seems to hinge on one simple, and you could say, totally irrational fact. And this central conflict is something that Barron's piece really nails down. They call it the Buffett paradox. I mean, that's really the big question here, isn't it? It's what the market, investors, pretty much everyone is wrestling with right now. And it all comes down to one person. The man himself, Warren Buffett. And here is that paradox in a nutshell. On one hand, you have Berkshire owning this absolute fortress of A-list companies. We're talking some of the biggest, most respected brands in the world. But then, on the other hand, the stock itself, it's just not performing like an A-lister. It's actually lagging, and that creates this major disconnect. So what is going on here? What's behind this weird behavior? Well, according to the analysis in Barron's, the market's anxiety isn't really about the company's performance or what it owns. No, it's focused almost entirely on one single data point. 94. That's it. That's Warren Buffett's age. And that one number is having this huge, outsized impact on how investors are valuing his company. It's almost like the market believes that without him in charge, all the magic just vanishes. And you can see that fear right here in the numbers. While the S&P 500 has climbed over 9% this year, look at Berkshire. It's up less than 4%. That gap, that is the Buffett paradox in action right there on the screen. But the Barron's article basically asks, is this fear even logical? I mean, think about it. Is it really plausible that a master planner like Warren Buffett hasn't meticulously prepared his company for this exact moment? The author's take is pretty blunt. The idea is just plain silly. So, this brings us to the other side of the coin. The argument that Berkshire Hathaway was never just a one-man show. It was actually designed from the ground up to be a financial fortress, an engine built to last long after its architect is gone. First thing to know, the succession plan is not some big secret. It's been clearly spelled out. Greg Abel, a longtime Berkshire executive who runs the company's massive non-insurance side of things, is the designated successor for the CEO role. The handover is already mapped out. And second, just look at the sheer strength and diversity of what he's set to inherit. This is not just a collection of stocks. We're talking massive, essential businesses, railroads, energy, world-leading insurance companies. And that's on top of these enormous stakes in the world's most iconic brands. It's a powerhouse. And then there's the war chest. $350 billion just sitting in super safe U.S. treasuries. Now, that's not just cash. That is pure firepower. It gives Berkshire this incredible ability to make huge, game-changing investments when everyone else is scared and selling. So you've got the market's fear on one side, and you've got this fortress of a company on the other. According to the article, that very disconnect, that gap between perception and reality, might have created a really powerful opportunity in disguise. So here's the core idea, the investment thesis. The market is so fixated on one emotional thing, Buffett's age, that it's kind of ignoring the rock-solid fundamentals of the business. And that fixation has created a valuation gap, which could mean the stock is actually a bargain right now. Now, for anyone who's buying into this thesis, the Barron's column lays out a couple of paths. The first one is simple, just buy the shares directly. The second is a bit more advanced. It's an option strategy called selling puts. Basically, it's a way to get paid for agreeing to buy the shares later, but only if they drop to an even lower price that you get to pick. When you zoom out from all the numbers and the strategies, this whole situation really builds to a much bigger, more universal question. What is it that really allows a great company to last for generations? At the end of the day, a bet on Berkshire's future isn't just a bet on the next CEO, or its cash, or even its collection of amazing businesses. It's really a bet on the incredible power of the culture that Warren Buffett spent more than half a century building. The question is, Can that culture outlive the man himself? Well, that's what the market is about to decide.